Good morning. This is Barry Knapp with Ironsides Macroeconomics at 7 a.m. Monday morning, June 17th. This is the introductory version of our weekly audio summary, which walks through our weekly note. The note this week was titled The Good Place. One quick note before we get started, which is for those of us who aren't really deeply familiar with our work, we gave an interview 2 weeks ago to Jack Farley, who runs the really interesting podcast called Forward Guidance. And so that is available. I included the link on the email associated with this. It'll also probably be up on the YouTube page as well. And you can listen to an hour-long broader discussion about my views on the markets, going all the way back to the origins of the current policy environment from our front seat of the financial crisis at Lehman Brothers. So moving on to this week's themes, the good place is a reference to Chair Powell saying inflation is in a pretty good place. We discussed what we see as an unhealthy broadening out of equity market performance. We have a rule of thumb that if equity market relative performance persists for 3 months, then it is a pretty robust economic indicator. And so the unhealthy broadening out describes how we had small caps underperforming, consumer discretionary underperforming, small financials underperforming. These are lead sectors for most of the year. But over the last 3 months, 1 month, and it accelerated last week, we saw that unhealthy broadening out to large cap financials struggling, industrial struggling, energy, materials. These are, industrials, energy, and materials are sectors we're overweight. And so we're getting increasingly concerned that the equity market is sending a signal that the economy is starting to deteriorate and we could get a full-on growth scare related correction. We discussed Dow Theory and the performance of the fixed income market in the note as well. The fact that a 10-year auction went really well even before Wednesday's CPI seemed to cast something of a verdict on last week's discussion, which was the tale of two surveys, the employment report, weakness in the household survey and strength in the establishment survey. We've been discussing how the establishment survey likely overstates small business employment because of some of the lag data that's coming out from the quarterly census and employment and wages. There was some more information on that last week from the research department at the Philadelphia Fed, which looks at state level data and estimates that, employment growth in the fourth quarter of last year was pretty tepid, much more tepid than the 1.6% growth that the establishment survey showed. So that was the introductory part of the note. We then really dug into the inflation number that were unequivocally good news for the Fed's policy reaction function for the markets in the near term. That drop in inflation volatility is good news for equities over time. We are comfortable with the idea that inflation could run at 3%, but that would mean stronger nominal growth, positive operating leverage for companies with high fixed costs like industrials, energy, and materials, but not good news for the Treasury market over time, where at 4.25% 10-year with a negative term premium, if we are going to have 3% trend inflation, and we discuss in the note with what we call deadweight sectors, sectors like healthcare, housing, education, why it'll be very difficult to get to 2%, fiscal policy playing a major role there as well, and how that will be bad news for treasuries, but not necessarily bad news for equities. So then we went on to discuss the Fed, and really within the context of the twin evil curves, we've called them at points in the past, the Beveridge curve and the Phillips curve, how Chair Powell's comments really intimated that they are concerned that QCEW type analysis, the real digging into the labor market, is showing signs of deterioration. They're putting a good, face on all this by saying, oh, the labor market looks strong. But in fact, it does look like the labor market might be much weaker. And any further weakening would be what would get the Fed started down the path of cutting to 4%, the level that we think would painlessly disinvert the curve and relieve all that pressure on the bank credit channel, small businesses, and small builders, real estate developers, and the like. So from a portfolio perspective, we consider reducing risk a little bit further. We didn't do it this week. Our last move, if you all recall, was to cut our weighting in consumer discretionary, which is the leadingest of the leading indicators. We'd be tempted to push out the Treasury curve a little bit into the belly, but there's no value there. So stick with 2 years for now, and we would hold off on putting any new money in the equity market. Barry Knapp from Ironsides. By all means, please consider becoming a full subscriber to our work, and you can get all these details in a weekly note along with our portfolio and sector allocation recommendations. Have a good week. Thank you.